now that we recognize we're in a bear market, are there any advantages that, as investors, we can look to be able to benefit from this bear market?
Thank you, Linda. I think I was just thinking how I used to remember what a bear market and a bull market is when I was younger, is that bears attack downwards. A bear slaps you like that, so that's down. Bulls, they attack upwards, so the market is going up. So just in case you're wondering, even in accounts, you used to wonder debit, credit. That's how you remember. Anyway, the market is the pulse of an economy. That is very true, as Mary has said. And in as much as we are in unprecedented times, and I think it's important to mention this, because for those of you who are a bit more aware about how markets work, usually you would expect that when we're in a bear market, then bond valuations are also high. Foreign investors in, say, Safaricom, at the beginning of this was about 70%. This is the float, forget Vodacom. By about 2-3 weeks ago, when I last checked, the foreign investors in Safaricom were only 7 or 8%. Now that indicates that this downturn has been pushed by a lot of supply of shares, not because Safaricom has become less profitable, not because Safaricom is not one of the best companies in Kenya, not because that company, and this is the case for several other companies whose share prices have gone down. So if I'm holding those shares and my share price is going down, I have two options. One, if I see the foreigners or whatever is going to cause it to happen, remember COVID, same thing happened. If I see that something is happening that is going to cause the share price to go down significantly, then I should have sold before it went down, and then probably then moved my money toward a safer haven. Unfortunately, a lot of us didn't do that. So now I'm sitting on, say, a share that was 40 bob, and now it is 20 bob. Now, of course, it's the most difficult time for me to come and tell you to buy more, but it makes a lot of sense to say, since this company is still very profitable, since it is still doing very well, and the only reason the share price has gone down is not because of the company itself or its profits, but because of an external factor, then I buy more shares at the lower price, which means the ones I bought at 40 bob, if I consistently buy at a very low price, may come down to something like, I'll give you an example of, say, I'll use Safaricom, which came from around 44 shillings down to around 13 shillings. So I can bring that 44 shilling price down to something like 25, which means when all these issues end, let's assume these wars end and life comes back to normal, inflation, wheat prices, fuel prices, etc., have come back to what we were used to before the wars and COVID, then what is going to happen? The same thing that happened after COVID. These shares will jump. And when they jump, then I will get back into profit earlier. That is called dollar averaging, but in Kenya, it is shilling averaging. So basically, I am averaging down my price so that I can be able to at least position myself for profit. The other thing is to also look at your portfolio and think, wait a minute, I have certain companies which are no longer profitable, are not doing very well. Maybe they have come out of what they're doing is even old-fashioned, maybe, and that's why these companies are their share prices have gone down, which means fundamentally the company has a problem. Now, normally it had to sell this because you're in loss and buy another one, but now you're thinking, why don't I sell these ones, which we call toxic stocks? Why don't I sell these ones and use the same money to buy these ones which are down but are strong fundamentally? Because if the market turns tomorrow, these ones will stay down, but these ones which are very good fundamentally will jump. So again, that's another strategy. We call it portfolio restructuring. The third option, of course, is you're not in the market yet. I think this is the best time in my entire career to be getting into the Nairobi Securities Exchange. We are looking at companies that were in the 50s, sitting in the 20s. They're fundamentally sound. They are doing very well. They're even expanding into new markets in East Africa, and they're growing, which means this is actually a very good time to buy. I think I will quote Warren Buffett here, that most people get interested in stocks when everybody else is. The time to get interested is when no one else is. You can't buy what is popular and get rich. That's Warren Buffett for you, and I think it sums up my whole story. Thank you, Linda.